We got through 1998, we got through the dot-com crash, we got through 2008, we got through 2020 and COVID. There's actually a good size market drawdown in 2018 between October 1st, 2018 and Christmas Eve, what I call the Christmas Eve massacre. Stock markets dropped 20% in under 3 months. When the Fed kept raising interest rates, even though the economy was weakening. So they have seen those, but every single time it came back, even in COVID, March, April 2020, the stock market went down 30%. It did. I mean, just almost straight down. But by September, we were back to new all-time highs. And so it's not that they've never seen that kind of volatility, but they learned the wrong lesson, which is it always comes back. And we know why, because the Fed bails you out, the Fed floods the zone with money, the Fed talks it up, et cetera. But the counterexample in 1929, when the stock market did crash, it was down 23% over 2 days. It was like a 12% day and an 11% day in late October 1929. But it kept going. The stock market crashed in October 1929, but it bottomed in June 1932. That was a 3-year moving crash or rolling crash, whatever you want to call it, with some rallies along the way. And the total damage was over 80%, not 30%, not 40%, down 80%. And what people don't know, many people don't know, is you said, okay, then it rallied in 1933 and 1934. The Fed messed up again and blundered again, as they usually do, in 1937 and threw us into a double dip. But if you ask people, okay, well, everyone knows the stock market crashed in 1929. When did it regain those highs? How long did that take? The answer is 25 years. It was 1954 before the market recovered from 1929. Now, it doesn't mean there weren't gains along the way or you couldn't make money. You could. But if you say, oh, I'll just sit tight and wait till it comes back, well, a lot of people didn't live long enough. They never saw their money back because they didn't live 25 more years. So that's a real bear market. It's happened before. The point is you need to be prepared for things like that. And no one alive, but very few people alive have seen anything like that. And if you say, well, what if we had another market crash right now? We'll talk about reasons why in a second. Why couldn't the Fed just come right back in and print some more money and do the same thing over again and bail out the new failures, whoever they may be? You can just kind of keep bailing things out. Why not do it again? What's the big deal? Well, the answer is each bailout is bigger than the one before. And that's the point. You can go all the way back 1994, Mexico, 1998, Russia, LTCM, 2000 dot-com, 2008 Lehman, 2020 pandemic. And they do bail out, but each one's bigger than the one before. I mean, we threw out $6 or $7 trillion of new debt on top of a $1 trillion a year baseline, $7 trillion in new debt to kind of dig our way out of 2020. So there is a limit. There comes a time when it's like, hey, this bailout is going to be 20 trillion, sorry, that check's too big. We're going to have to let some things fail. So what could happen? The first thing on my list is we're heading for a very severe recession. I just want to kind of explain briefly the dynamics of that. So the Fed's raising interest rates. We know that they started, so it wasn't that long ago, but March 1st, 2022, the Fed policy rate was zero. It was 0%. People remember Paul Volcker. Oh, Paul Volcker raised interest rates to 20%. Well, he did, but so far Powell hasn't raised them as high, but he's raised them fast. I mean, even when Volcker was working his way to 20%, it took 3 years from 1979 to 1982. So Powell's plan is clear because he's told us. He said inflation is job one. It's not that we don't care, but unemployment is going to go up. We're going to have a recession. He doesn't use the R word, by the way, but it's implicit in everything he says. We are going to have a recession. Unemployment is going up. And too bad. It's kind of too bad because we got to get inflation under control. And so the Fed is in search of something that they call the terminal rate. What's the terminal rate? The terminal rate is a rate that's high enough to bring inflation down on its own without further hikes. So it doesn't have to be higher than inflation. It has to be high enough to cause inflation to come down to the Fed's goal of 2% without hiking more. And when they get there to that terminal rate, they'll sit tight. They call it the pause. And the pause could be a year. And Powell said this. Again, this is right out of his script. So Powell's in search of the terminal rate. By the way, if you said to me, "Hey Jim, what's the terminal rate?" I would answer truthfully. I would say, "I don't know," but neither does Jay Powell. Jay Powell doesn't know what the terminal rate is. He's kind of saying, "We'll know it when we see it, but we're not there yet, and we're going to keep going." And they have what they call the DOTS, silly name, but the members of the Board of Governors and the Federal Reserve Bank presidents give estimates, or their estimates of unemployment, inflation, growth, and interest rates for the next 3 years, and they put them as dots on a chart, so they call it the dots. And then Wall Street gets the dots. They do a central tendency and regressions and all this stuff. One of the top Fed insiders, like, practically sits in Jay Powell's lap, and has all the way back to Bernanke and Yellen, told me personally. He said, inside the Fed, they regard the dots as a joke. They're not better than guesses. Their forecasting ability is dismal. You or I would have better forecasts, and they wish they could get out of it, but they don't know how. So that's the truth. But the problem is, Wall Street and the financial media and the talking heads on CNBC, they want to talk about the dots, and it does affect market behavior. So even though it's a joke, even though the forecasts are terrible, you have to pay attention because it affects the markets. And if you're affecting the markets, you're on the wrong side, you're going to get run over. So I look at the dots not because I put weight on them as predictive analytic tools, but because the market pays attention. The market says, hey, inflation's already coming down. And so the market says, hey, you did it. You're already there. Inflation's coming down. Why don't you stop? And by the way, you're going to get the message. The economy is going to be slowing down. Inflation is going to be coming down. And then you're going to cut rates. This is the famous pivot. Whenever you hear of the Fed pivot, that's when the Fed turns around and starts cutting rates instead of raising them. And that'll be just in time, and growth will slow, but it won't be too bad. And we'll come in for a soft landing. And this is the Goldilocks scenario. So again, typical Wall Street, get the pom-poms out, the Fed's going to cut rates, and so buy stocks. That's all Wall Street knows, is buy stocks. But the conundrum is inflation coming down because the Fed is still hiking, or is the inflation coming down because they're at the terminal rate? Well, we don't know. It's kind of hard to sort those things out. Powell would say, yeah, it's coming down. I know that, of course, but it's because I'm hiking, and I'm going to keep doing it. My view is, no, you actually did it. It's mission accomplished. You just don't know it. That means, as usual, they're going to screw it up. They're going to blunder. They're going to go too far. And it's not going to be a mild recession. It's not going to be Goldilocks. In this version, Goldilocks gets eaten by the bears. In other words, you're going to throw this economy into a very deep recession because you're going to go too far, as usual. And you're not going to know it until too late. By the time you realize it's mission accomplished, you will have gone too far, too long, rates are going to be too high, and it's not going to be a soft landing. If Wall Street's talking up the stock market based on the soft landing Goldilocks scenario, but Powell's going to stick to his guns and raise rates too high, that's going to cause stocks to crash very severely, very suddenly. If the market were adjusting, say, yeah, Powell means it, he's going to keep, we ought to come down a little bit, that would be one thing, but that's not what's happening. The market's trying to rally. Powell's warning people what's going to happen. They're not listening, and it is going to happen. People hear the government say, the economy's fine, or, unemployment's near an all-time low, which actually statistically is true. And they kind of nod and go, yeah, it's all good. And then reality is the stuff that hits you in the head like a 2x4. The propaganda is positive. We can talk about that in a little more detail. The reality is harsh, and reality wins. There's a very good book on this by Robert Shiller, Nobel Prize winning economist at Yale University. I'm not a huge fan of your garden variety PhD economists, but there are some good ones out there, and he's one of them. He wrote a book about, 2 years ago, maybe a little bit less, called Narrative Economics. He said, yeah, we got all the models and Phillips curve and wealth effect and various quantity theory money, and some have a place, some are more valuable than others, but don't underestimate the power of a narrative. A narrative is a story. It's basically it's a fancy name for a story, but a story that persists, that grows. And interestingly, in epidemiology, of course, we've just come through a pandemic. There's a model called the SEIR model that stands for susceptible. Are you susceptible to a virus? E for exposed. Are you exposed to it? I, are you infected? Did you get it? And R, did you recover? The difference between I and R are people who died. But it's a model, and it's mathematically based, and it's empirically validated, of how viruses spread exponentially. And You can also use it to forecast how a virus is going to go. Well, what Schiller did, he took that model, moved it over to economics, and took a narrative kind of like a virus, not in a negative sense, but just as something that spreads. And it can be very powerful, and then eventually may die out or reverse, but it can be powerful in the meantime. That much I knew, but what I learned from the book that I hadn't really thought about is that narratives don't have to be true. They can be true and they can be very powerful, but a narrative can be false and still be powerful. If it's the self-fulfilling prophecy, if enough people believe it, it sort of becomes the reality to some extent, even if it's based on false premises. He gives an example during the Great Depression. The Great Depression really was two technical recessions, but there was a period from 1929 to 1933, election of Franklin Delano Roosevelt. And then there was another period from 1933 to 1937. The 37 and 1940 part we leave aside for this purpose. But during the first part of the Great Depression, unemployment was high, output was dropping, trade was dropping. It was a very, very bad time, no doubt about it. But not everybody was out of work. Not everybody was poor. There were a lot of people with a lot of money at the time. But it was felt that being ostentatious was poor form. It's like, okay, I'm lucky I have a job, I've got some money, but I'm not going to buy a new car, buy a big house, or flash it around or whatever, because it's really not considerate of all the people who actually have fallen on hard times. Well, that was the narrative, but it's the worst possible economic advice, because is precisely the fact that people with the money should keep spending that kind of can boost the economy out of a depression. So by people saying, well, even though I have the money, I'm not going to spend it because it's poor form, we're actually prolonging the Great Depression. Now, when FDR came along, he was elected in 1933, became president in 1934, the psychology turned 180 degrees, and all of a sudden, the Democratic campaign song was "Happy Days Are Here Again," and FDR seemed to solve the banking crisis and so forth. And all of a sudden, it became okay to spend money. Well, in the middle of the Great Depression, 1934 to 1936, those were some of the strongest years ever for the stock market. And unemployment did come down a lot. Now, the problem is it came down from like 25% to 15%. Well, 15% is still, painfully high, but it was a big move in the right direction. So he describes how the narrative flipped from don't spend money, it's poor form, to, go spend money and help the economy. None of that is taught in business school. It's not taught in economics. It can be modeled using this epidemiology model, but it doesn't fit into any of the standard macroeconomic models, but it's powerful stuff. And so today what's going on is that the White House is trying to push a narrative, and they're failing badly. But they'll say, if you listen to deliberations among White House officials, some of the stuff leaks to the press, and I know some of these people. It's like the economy's great, unemployment's really low. We've created all these jobs since the pandemic, but we're doing a really bad job of messaging. The point is, they're inside the White House. They're frustrated that the positive economic story is not getting out. The correct analysis is that there is no positive economic story. The economy is in terrible shape. The problem is not the messaging, it's the message. And this is where I say the propaganda from the White House that things are great is at odds with the reality, which is things are not great. Let me give you some specific data points, because as I say, I don't like to make statements like this without backing it up. Number one, the inflation was going up long before the war in Ukraine started. So if everything was great until February 27th, and then Russia invades, and then all of a sudden the inflation goes up. All right, let's talk about it. But that's not true. This inflation goes back to late 2021. It was persistent in the fall. We all remember the Fed and the Treasury saying transitory, transitory, transitory. And then finally, I think Jay Powell was testifying before Congress. He said, it's time to retire the word transitory. So that was his way of throwing in the towel. And Janet Yellen admitted she was mistaken also. So it predates the war, number one. Number two, energy prices are going up because there's a war with Russia. Well, I wonder why that is. Well, the reason is not because Putin invaded Ukraine, it's because the U.S. counterattacked with financial sanctions. Now, bear in mind, go back to January 21st, 2021, when Biden was sworn in as president, and then went back to the White House. What was the first thing he did? He closed the Keystone XL pipeline. This is a pipeline that would bring oil from Alberta, Canada, into the United States, where it would connect at a hub believe it's in Kansas, but somewhere in the central United States. And then the hub distributes it to the entire country. So he shut down that pipeline, which curtailed the supply of oil from Canada. Then ended new leasing, oil and gas exploration leasing of federal lands, handicapped the fracking industry, took a number of other steps using environmental tools, climate alarm, government subsidies, et cetera, to basically, to the extent possible, shut down the U.S. energy industry as much as possible. Now, you can't shut down completely, of course, but everything happens at the margin. And then we end up with oil prices doubling or tripling, really, from $40 to $120 in under a year, which is comparable to what happened in 1973 with the Arab oil embargo. And then Biden wakes up and says, guess we need more oil. And he wants to reopen leasing. I said they shut it down. They did, but he wants to reopen it. He's begging Saudi Arabia to pump more. Saudi Arabia is kind of not returning his phone calls. He's begging Venezuela to pump more. Oh, great. The greatest pariah dictator in the Western Hemisphere, and we're begging him for oil. So why don't we drill our own oil? Because we were a net exporter up until 2021, and then Biden came in, and we lost that edge and became a net importer, including recently buying oil from Russia. They curtailed that for political reasons, but that's kind of where we got to. So you wonder why the price of energy is going up. In other words, this damage was self-inflicted, but don't be misled by the headlines because they're, again, this narrative, but they're not actually doing it. So the point being, the price increase and the inflation in the U.S. has very little to do with Putin, and everything to do with the U.S. handicapping its own energy industry, begging dictators for oil, and the influence of the climate alarmists. And by the way, that whole crowd want higher gas prices. They want gas to be $7, $8, $9 a gallon because they expect that will accelerate the transfer to electric vehicles and make the electric vehicle more attractive relative to the internal combustion engine. Now, that's another fantasy. It won't happen. We don't have time to go through all the physics of it. And, output of energy by weight, gasoline compared to batteries and the pollution of batteries and the fact that, we don't have the charging stations. And even if we did, where's that electricity coming from? Oh, coal. It will never happen. But meanwhile, they're destroying the U.S. economy in pursuit of an ideological point that will never actually happen. Another example of propaganda versus reality. Narratives are powerful, but reality is more powerful. Disinflation, definitionally, but maybe even deflation is the opposite, at least for the time being. Inflation is the end game. It has to be because there's no way out from under the debt. But right now, and people are still worried about inflation. Prices are still going up. I put gas in my car just like everyone else. So I'm well aware of it, eggs, bacon, et cetera. But inflation has been coming down steadily since June of 2022. So about 7 months in a row, 8 months in a row. It peaked then. We all know what gas prices were doing and so forth. But the reason is kind of interesting. And inflation, nominally, prices are going up. Okay, so that's inflation. But it can come from two sources that are opposite. One is from supply side shocks, supply chain disruption. We saw that in 1973 with the Arab oil embargo over the Arab-Israeli war at the time. The price of oil quadrupled, et cetera. That was a supply shock. The thing about supply side inflation is it's self-negating. It burns itself out. So, the old saying, and it's true, the cure for high oil prices is high oil prices. In other words, when things get too expensive because of supply disruption, people can't afford them, businesses close, you get layoffs, you go into recession, and prices come down pretty quickly after that. The other source of inflation is from the demand side, and this is a completely different dynamic. We saw this in the late 70s, where prices are going up, but people have some bargaining power. So unions are on strike; they're getting higher wages. I worked at Citibank in the late 70s, early 80s. They used to give us raises without asking. They just say, here's another $20,000, because they knew that the cost of living was going up. And we would all change jobs if they didn't pay us more. So, but that feeds on itself. So the supply side disruption tends to snuff itself out. The demand side inflation tends to feed on itself. It gets out of control. And then we saw what Paul Volcker did with interest rates in 1981, where he took them to 20%. He caused a recession in terms of tight monetary policy to snuff out the inflation. But otherwise, if you don't do that, that just runs away. Now, the inflation we saw in 2022, late 2021, 2022, it was real. It wasn't transitory the way Jay Powell said. The price of gasoline doubled, more than doubled, and all the other complaints you hear The filling up your Ford F-150 pickup truck went from $70 to $140, which for a lot of people that meant they couldn't eat or couldn't go out. It was killing demand in entertainment, shopping, retail, a lot of other things, which again tends to snuff it out. So that has happened to a great extent. Starting in June 2022, that was the peak, and this inflation has been coming down. Now, it's still too high. The Fed's not done. We're going to see at least one more interest rate hike, maybe, but they're going to leave one more on the table. We'll see what happens in June. I'm not forecasting June, but I would not rule out another interest rate hike in June after the May hike. So, because Jay Powell's thinking, how many times do I have to say this? He's given 9 speeches since August 2022, August 26th at the Jackson Hole, then September FOMC meeting, November FOMC meeting, end of November, a speech at the Brookings Institution, December FOMC, congressional testimony, et cetera. And every time he said the same thing: inflation is job one. We've got to get unemployment up. Believe it or not, we're going to have a recession and unemployment's going to go up. Sorry about that, but we've got to get inflation under control. And until we do, what's under control mean? Well, it's 2%. That's their goal. Well, it's come down from 9 to 5. Nice job, but 5's still a far cry from 2, and it gets harder as you go along. And they're searching for what they call the terminal rate. So the terminal rate, no one knows what the number is. I don't know because Jay Powell doesn't know, but the terminal rate by definition it's a rate that's high enough that it brings inflation down on its own without further rate hikes. Because so far they've been raising rates and inflation's been coming down. Okay, that makes sense. And they can keep raising rates and it'll come down more. But is there a level where we're there, now we can sit tight, the famous pause, and inflation will keep coming down? Now you don't know because it's not a controlled experiment. You can't do it twice. But they're getting close. So whether it's 5.25, 5.5 remains to be seen. But that's the terminal rate. But then Wall Street came up with this narrative, oh yeah, as soon as they're done hiking rates, they're going to cut them. This is the famous pivot we've been hearing about for over a year at this point. No, as far as they're concerned, forget rate cuts in 2023, maybe mid-2024, we'll get back to you on that. But there's one wild card in the deck, which is, that's the Fed's plan. So I just gave you the Fed's game plan. It's not, you don't need a crystal ball. They tell you what they're going to do. All you have to do is listen, although a lot of people don't. Wall Street makes up their own version of that. But the idea of rate cuts following hitting the terminal rate is, well, rate cuts go down, so dividends look higher, so buy stocks. Wall Street is always buy stocks. That's always the punchline. But they might cut rates late in the year, not because it's their plan, not because they want to, but we could be in a very severe recession. And at which point, because the Fed's always late, they're always following the market. They never lead the market. If they've already raised it, let's say they may already be at the terminal rate, not know it. And so if they keep raising, which I expect they will, they may throw this economy into a very severe recession, at which point they may have to cut rates, not because it's in the playbook, but because unemployment goes up to 7%. And but that gets back to the first question, Constantine, which is what's next? Disinflation, maybe deflation. The answer is diversification. Everyone goes, oh, we know that, diversification. But they know the term, but they actually don't know what diversification is. And I'll give you an example. I run into people all the time. They go, well, Jim, I'm fully diversified. I have 50 stocks in 10 different sectors: telecommunications, semiconductors, consumer non-durables, metals and mining. And I go, you're not diversified. You may have 50 stocks, but you're in one asset class called stocks or equities. And they're all going to go up together or they're all going to go down together. And the more stressful the condition, the more reason you have to be concerned about it, the higher the correlation. On any given day, some stocks go up and stocks go down. But when you dial the stress meter up, they all tend to move together. So I don't care about your 50 stocks, your 10 sectors, that's not diversified. So what does real diversification look like? Have a sleeve of equities if you want, that's fine. I would say I look hard at oil, natural gas, natural resources, agriculture. Again, kind of equities that have hard assets behind them that will do well in inflationary times or even in recessionary times, because you need all those things no matter what. Then a slice of real estate. I wouldn't be in commercial real estate, but residential real estate, income producing real estate, farms, etc. That's good. I have a big slug of cash. And people go, well, cash doesn't have any yield. Well, lately the yields, you can get 2% 2-3%, on like a CD. But even in a simple savings account, it is quite low. It's kind of less than 1%. But people don't understand the value of cash in a couple of respects. Number one, in a deflationary environment, we're not there yet, but we could hit that if the recession gets bad enough. Cash could be your best performing asset. It doesn't go up in nominal terms, but it goes up in real terms. If you have 2% deflation, your cash is worth 2% more in terms of purchasing power. But the real value of cash is optionality. And this is not well understood. I shared an office with Myron Scholes for 6 years, so I see options under the pillow, so to speak. But if you're the one with cash, when things, first of all, it'll definitely preserve wealth. So if things are falling all around you, your cash will be what it's worth, unless you're in Silicon Valley Bank. It's a separate issue. But although they got bailed out. But so it'll preserve wealth, even if it's not a high performer. It'll do very well in deflation. But the real benefit is when everything else is falling apart, you're the one who can go shopping. So it's kind of an at-the-money call option on every asset class in the world. Everyone's selling everything in a panic. You can bide your time, watch it go down, look for a bottom, and then say, okay, now I'll buy these things down 30% or 40% or 50% from where they were. Some alternatives. I have a number of investments in private equity and venture type situations, and they're risky and they're not liquid. But some of them will do very well. Some of them have done well, so that's nice. And then a slice of gold. And I recommend 10%, because people, they put words in your mouth. They go, Jim Rickards says, sell everything and buy gold. I've never said that. Not a good strategy. But 10%, yeah. If one of our supply chains or one of another country's supply chains that we rely on collapse, it could cause an unprecedented economic super collapse on a global scale. And that's how we could end up with this $85 trillion economic super collapse I'm predicting. $85 trillion being the value of the global economy. Because remember, our current supply chain is interconnected on a global scale. And if there is a single point of failure, the whole system is going to come collapsing down. Farming, banking, healthcare, oil and gas, tech, and so on. This isn't the first time I've warned Americans about this before. On May 11th, 2020, I told my followers, the economy will not return to normal for years. There are serious constraints on supply. I issued another warning about my research on November 24th, 2021. The supply chain difficulties will certainly grow worse. The remedies will take years and sometimes decades to implement. And yet another in 2022. Don't believe the happy talk about a temporary supply chain crisis. I'll say that again. The crisis will last for years with predictable negative effects on economic growth. But now things are even worse than ever before. And I fear this economic super collapse could hit American soil in the next 6 to 12 months. So this may be my last and final warning before it's too late. It's why I'm warning people around me it's only a matter of time before the world economy comes crashing down. Because when you talk about risk of catastrophic collapse, the risk increases with the size of scale. Look, whether you decide to listen to me today about how to prepare, whether or not you decide to get access to the information in this envelope, that's up to you. It's a free country. You can do what you want. You can even pretend you never heard me tell you any of this. But just know, Joe Biden certainly isn't going to come to your rescue. Take a look at this 9-second clip from the president.
When do you think things will get back to normal?
When do I think things will get back to normal? But my hope is by this time next year, we're going to be back to normal.
That clip was taken over 18 months ago. It's up to you what you believe. But I can't bury my head in the sand and ignore all the facts. And the facts couldn't be more clear. So in just a moment, I'm going to explain how you can get access to this information inside the envelope as part of my super collapse preparation package. And I'm going to talk about what to do to protect and even grow your wealth. Look, please understand, it brings me no joy to say this. And I hope the worst of what I'm warning of never comes to pass. But there's only one potential solution to this crisis, and it's going to take years. Recently, I spoke to a very well-informed CEO of a major corporation, and I asked him point blank, I said, your company must be looking ahead at some possible solution. Is there anything you can share? Well, I'm going to tell you the same thing he told me. He said, Jim, you have to understand that it took us 30 years to build these supply chains. We blew it up in 3 years, beginning in 2018, and you can't put it back together. But there is one thing we can do. It's not a quick fix, but it's our best and most sensible option. Our only way out is to build a new supply chain that eliminates the bad actors. We can't continue to allow our enemies like China or Russia or Iran to threaten consumers here on American soil. As the Wall Street Journal wrote, Russia's lengthening war with Ukraine will lead to a near doubling of inflation rates in rich countries. It's why the New York Times wrote, "This is what happens when globalization breaks down." And why Barron's wrote, "Secure U.S. supply chains with allies and move out of China." Unfortunately, this solution could take years or even a decade to fully implement. And that CEO told me it will take at least 10 years to reconstruct the supply chains if we don't want to do it with China and globalization. But whether you realize it or not, that's the bet we're making as a nation. It's happening now. And when the dust settles, we're either going to have rolled out this new supply chain before a worst case scenario happens, or we're going to face whatever lies ahead from this $85 trillion economic super collapse. Now, maybe you're wondering how bad things could really get. Let me answer that question with another question. Do you remember your life at the beginning of the pandemic? Despite all of our freedoms we all hold so dear, an unelected official with the ear of the president recommended immediate lockdowns, and suddenly we heard demands like shelter in place or stay at home, backed up by the threat of arrest. Large swaths of the economy ground to a halt. Looting took over our towns and cities. Because so many businesses were shut down, people were emboldened to take to the streets. But if most Americans don't have access to enough food, water, or other necessary supplies, do you really believe our streets and our businesses won't see more violence? It's why gun sales keep hitting all-time highs as more and more Americans prepare for whatever lies ahead. And while I hope the worst of what I'm warning in my urgent new book never comes to pass, I don't suggest you rely on hope to protect yourself and your family. I'm certainly not. Here's how I'm ensuring my family's well-being. First, I would suggest stocking up on essentials, just like I've done. I have a fully finished area in the basement of one of my properties, the address of which I keep totally private. It provides me with a warehousing area for months' worth of canned foods and other non-perishable provisions. That's important. Don't stop with a 3-day supply like the CDC recommends. Make sure you have enough water, basic food, and toiletries to last at least 3 months. And keep them in a safe area where they can sit without damage or spoiling. I would also recommend buying several large capacity freezers. I already have 3 and I may continue purchasing more. If you have the means, consider installing alternate energy solutions in case of a worst case scenario. I've already installed the largest non-commercial solar power system in New England on my property. If you can, have alternative sources of power generation on your property. I've also dug 3 wells, planted abundant gardens, and built a significant greenhouse. But whatever you decide, do recognize that none of it will matter if you're not getting accurate information about what to expect in the coming days. Like I said, to be able to make the right decisions during a crisis, you need to lean on someone. So if that's not me, you should find another well-connected person you can trust, ideally someone who's previously held a position of power in our government. But if you want to learn what's inside this envelope and see what I know, right now is your chance. See, I've gone ahead and published this information I'm holding here in this envelope inside my newest book. It has brand new proof of the unfolding situation and inside level details on how it will play out. Urgent Preparation Report number 1. Buy this asset after securing your family's food and energy. As the economy collapses and the shelves are bare, the government will respond by printing even more money. When it does, the value of the dollar will be destroyed through inflation. But 5,000 years of history proves that one item, gold, outlasts every other currency as a form of money. And I believe that economic collapse occurring right now will send gold skyrocketing over the next 6 months. That's why I'll send you my urgent report called The Perfect Physical Gold Portfolio. Everything you need to know about buying the right kind of physical gold as part of my Super Collapse preparation package. You'll find everything you need to know about investing in gold before the price blasts through the ceiling, including, is gold safe to invest in? How much should I invest in precious metals? What metals should I buy and what should I avoid? What are the best places to buy gold and other precious metals? What are the safest ways to store gold to avoid theft or government confiscation? And much more. Plus, I'll also send you Urgent Preparation Report number 2, my Biden Bucks Protection Plan. I haven't mentioned it yet, but during my research, I came across a troubling executive order that President Biden just signed. See, every time there's an economic crisis, the government responds with massive new programs to try and control the economy and its citizens. In 2008, it was bailouts of big banks and new government agencies to regulate the financial industry. This time, it will be much worse. I've uncovered a plan for U.S. government cryptocurrency I call Biden Bucks that I believe the government will unveil during this economic collapse to control your money and manage the societal fallout. By the time this program is announced, it will be nearly impossible for everyday Americans like you to protect their wealth and keep their privacy, which is why I've created another urgent report to get you prepared ahead of time. Inside this new report, you'll get step-by-step details on what these Biden bucks are, why they'll be used during this collapse, and how to outsmart this sinister program by creating, one, an off-the-grid fortune, secure $1.1 million in wealth inside a soda can safe. Two, saving your freedoms, have liquidity and spendable wealth without using Biden bucks. And three, growing your personal wealth. You'll get possible investment upside as events unfold. And four, ensuring you maintain your wealth regardless of external conditions. Building your own off-the-grid portfolio now will protect you from the government surveillance state coming during the economic super collapse. Biden bucks testing is underway. The digital dollar could be rolled out soon. Before it's too late, make sure to protect yourself and your retirement savings. You'll find everything you need in this urgent report as part of my super collapse preparation package. But that's not all, because you'll also get urgent preparation report number 3. Secure this secret off-the-grid asset. You see, I've learned of another little appreciated asset that's a liquid form of wealth. It can't be tracked or traced. It's completely legal and easy to find if you know where to look. Over time, its value has steadily grown, but very few people know anything about its investment potential. You're about to be one of the few. I believe you must include this secret asset in any off-the-grid portfolio. We're in a recession. I mean, it's not coming. We're in it. It's a triple, greatest bubble of all time, times 3 in the sense that it's real estate, stocks, and other asset classes. The largest, most sophisticated, biggest player, real money market in the world is telling you that the Fed's going to blink, that they're going to raise rates, but then things are going to get so bad, they're going to have to cut rates. And that's why we can see a liquidity crisis and a very severe recession coming well in advance. I haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on. Inflation was going up long before the war in Ukraine started. So if everything is great until February 27th, and then Russia invades, and then all of a sudden the inflation goes up. All right, let's talk about it. But that's not true. This inflation goes back to late 2021. It was persistent in the fall. We all remember the Fed and the Treasury saying transitory, 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 and then finally, I think Jay Powell was testifying before Congress. He said, it's time to retire the word transitory. So that was his way of throwing in the towel. And Janet Yellen admitted she was mistaken also. This is going to be part of what throws the economy into severe recession. They're raising rates and inflation is coming down. But what they don't know is, are interest rates coming down because they're raising rates, or have they already hit the terminal rate and it's coming down on its own and they just don't know it? And that's a big deal, because if they're at the terminal rate and they just don't know it and they keep tightening, which they are going to over tighten, probably already have. The energy prices are going up because there's a war with Russia. Well, I wonder why that is. Well, the reason is not because Putin invaded Ukraine, it's because the U.S. counterattacked with financial sanctions. Now, bear in mind, go back to January 21st, 2021, when Biden was sworn in as president, and then went back to the White House. What was the first thing he did? He closed the Keystone XL pipeline. This is a pipeline that would bring oil from Alberta, Canada, into the United States, where it would connect at a hub. I believe it's in Kansas, but somewhere in the central United States. And then the hub distributes it to the entire country. So he shut down that pipeline, which curtailed the supply of oil from Canada. And then we end up with oil prices doubling or tripling, really, from $40 to $120 in under a year. The other source of inflation is on the demand side. So you have what's called cost push inflation That's where, supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or, kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described. And as I say, I lived through the 70s, where, hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So inflation is coming down, no question. But is it because the Fed has continued to raise rates, or is it because the Fed has hit a terminal rate and all they have to do is nothing, just pause, as they put it, and inflation will come down where they want? The market believes we're at the terminal rate. The Fed should just stop right now, leave it alone. Sooner than later, pivot to, that's the new buzzword, pivot to rate cuts. And it's the anticipation of those rate cuts that has Wall Street all spun up. They get the pom-poms out and saying, buy stocks, buy tech, because the Fed's going to cut rates. The Fed does not see it that way at all. The Fed says, yeah, we're raising rates, inflation's coming down, but we're not at the terminal rate. We'll kind of know when we see it, but they think it's probably 5.25. That's a very good estimate based on what the Fed has said themselves. I started my career in banking in 1976, and so I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every like 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed whatever, a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50. During the first part of the Great Depression, unemployment was high, output was dropping, trade was dropping. It was a very, very bad time, no doubt about it. But not everybody was out of work. Not everybody was poor. There were a lot of people with a lot of money at the time, but it was felt that being ostentatious was poor form. It's like, okay, I'm lucky I have a job, I've got some money, but I'm not going to buy a new car, buy a big house, or flash it around or whatever, because it's really not considerate of all the people who actually have fallen on hard times. Well, that was the narrative, but it's the worst possible economic advice, because it's precisely the fact that people with the money should keep spending that kind of can boost the economy out of a depression. So by people saying, well, even though I have the money, I'm not going to spend it because it's poor form, we're actually prolonging the Great Depression. Today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food, you got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food, because you're moving it by truck, etc. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation. We're not quite at the stage where it's demand pull. We're not quite at the stage where individual consumers are behaving the way I described in the 1970s, saying, hey, better spend the money fast because it's losing value. This damage was self-inflicted, but don't be misled by the headlines, because they're, again, this narrative, but they're not actually doing it. So the point being, the price increase and the inflation in the U.S. has very little to do with Putin and everything to do with the U.S. handicapping its own energy industry, begging dictators for oil, and the influence of the climate alarmists. And by the way, that whole crowd want higher gas prices. They want gas to be $7, $8, $9 a gallon, because they expect that will accelerate the transfer to electric vehicles and make the electric vehicle more attractive relative to the internal combustion engine. Now, that's another fantasy. It will never happen. But meanwhile, they're destroying the U.S. economy in pursuit of an ideological point that will never actually happen. I'd rather be the U.S. than China. China's in even worse shape for different reasons. It's not so much interest rate policy, although they're subject to global interest rate policy and exchange rates coming from the Fed. But you can see it in real estate. It's a full-scale collapse. They're propping it up, but the buyers aren't interested. In other words, the Chinese government is telling the banks to lend money to real estate developers who can't finish housing. Well, that sounds good. It's like, okay, here's some money, finish the housing. But the buyers are not flocking in. The buyers have been burned. They're shying away from that asset class. They want to increase cash. They're looking at other asset classes. They don't have a lot of choices because China has very strict capital controls. They're trying to get their money out by means legal and illegal. They're buying gold when they can. But as I say, they may not have a lot of choices, but even money in the bank looks pretty good compared to what's going on in real estate. The problem is too big. The bubble is too large. It's gone on for too long. We don't hear about it the same way we did about the Japanese real estate bubble in 1989, 1990. That was an epic crash. Japan is still not recovered. I remember in the 90s, early 2000s, they talked about the lost decade. Well, try 3 lost decades. That's going into a 4th. That's Japan. I've lost count, actually 8 or 9 recessions since 1989, but it's really just one long depression. That's the way to understand the Japanese economy. China's going into something like that. We don't hear much about it because they're not transparent. They lie about their numbers. You need to look at private sources and use other analytic tools to understand what's going on there. But they've got drops in consumption, industrial output, real estate's collapsing. Their price indices are collapsing. All this fear of inflation. It's been around. It's real, but it's now turning around very quickly. And you can see that in China. China's going through something that the world has never seen. They're going to lose 600 million people in the next 50 to 70 years. This is a demographic implosion. This is worse than the Black Death. Of course, the Black Death killed somewhere between a third and half the population of Europe in the 14th century. It was a good time for labor, by the way. The labor was so scarce that returns to labor went up versus returns to capital because there weren't enough workers. But that's the only thing that can come close. Even the Spanish flu of 1919 killed about, no one's certain of the number, but between 100 million and maybe over 200 million people. The 30 Years' War was certainly, in the early 17th century, was certainly highly destructive. But what's going on in China now is worse than any of those things. It has to do with simple demographic math. The key number is 2.1. 2 people have to produce 2.1 children. Man and woman, or you can say per woman if you want, have to produce 2.1 children to keep the population constant. Why not 2? Why not 2 producing 2? The answer is infant mortality and those who don't make it to adulthood and can continue the repopulation of the planet, if you will. But they're not even close to that. They're well below 2. And by the way, so is the rest of the world. So is Australia and the US and Western Europe and a lot of other places. This is a global phenomenon, but it's particularly acute in China. It may be the case that China's replacement rate is or birth rate is actually 1. It has to be 2.1 to maintain. It could be 1 or lower. This is a demographic implosion unlike anything anyone's ever seen. It also has a dynamic. You can't reverse it very quickly. It feeds on itself, as I was talking about inflation earlier. So this is going to continue for 50 to 75 years. They're going to lose 600 million people. There are a lot of definitions of GDP, 4 or 5 part definition. There are more complex calculations, but there's one really simple definition. It only has 2 factors: population and productivity. How many people are working and how productive are they? That's nominal GDP. That's one definition of gross GDP or nominal GDP. Well, if your population is dropping from 1.4 billion to 800 million, you're losing 600 million people. And then what about productivity? Well, the other thing that's going on is China's population is aging very quickly. So you get a population of people in the 70s, 80s, and 90s with very large amounts of cognitive decline, dementia. Obviously, there's no productivity there, but it's worse than that because then you look at the shrinking population between the ages of 25 and 54. It's called that prime working age. More and more of those people are going to have to be involved in elder care. They're going to have to be basically caretakers or caregivers for the older population I described. A very worthy job, but not one that lends itself to productivity gains. Bathing hasn't changed in about 5,000 years. Robots don't do baths. The only real innovation in bathing in between 1870 and 1940, we did see the rise of indoor plumbing and hot water. That's good. I enjoy both, but that's it. I can't think of any other bathing innovations in the last several millennia. So if you have a shrinking working age population, a rising older population, high degree of cognitive decline, and a big slice of the working age population having to provide elder care or be caregivers for the older population, tell me where your industrial output's coming from. Tell me where your productivity is coming from. And sorry if I mentioned this already, but 50% of the water in China is poisoned because of, just their industrial practices. If you're a gold miner in Australia, I've invested in gold mines around the world. I know that places like Canada, the US, and Australia, if you use cyanide to leach the gold, and that's a very common technique, you have to account for every, microgram. Whatever you put in, you got to take out, weigh it, dispose of it properly. In China, they just dump it into the rivers, and so the rivers are poisoned. So China is an economic, demographic, industrial, moral, religious wasteland, and will suffer. It's already in a recession. Just to cut to the chase, again, they lie about their statistics. So here you have the two largest economies in the world, U.S. and China. U.S. is slowly going into what I expect will be a severe recession. China is in a century-long decline, unlike one that the world has ever seen. That could eventually lead to social unrest and a regime change, but let's not count on that in the short run. Just expect China to shrink and become more autarkic, decoupled from the Western world, and certainly not be a source of growth. Taiwan Semiconductor Manufacturing Company, the largest and most sophisticated semiconductor manufacturing in the world, and semiconductors are in everything. It's not just computers. There are 1,400 semiconductors in an automobile. There's a semiconductor or more in your dishwasher, your refrigerator, your washing machine. They're everywhere. Internet of Things. We all understand that. So TSMC, based in Taiwan. The United States has a military doctrine called the broken nest theory. And what it says is that if China, well, it comes from a Chinese proverb, ironically, and it says, if the nest is broken, how can the eggs survive? And what it means is that if China invades Taiwan, and I'm not forecasting an invasion, could happen though, we or the Taiwanese will very quickly destroy all the semiconductor manufacturers in Taiwan. We'll just blow them up. And China won't get anything. They'll have the broken nest. Taiwan Semiconductor knows this. They talk to the U.S. intelligence and military. The supply chain was breaking down before COVID. Now, of course, COVID made it worse, yes. And the war in Ukraine made it worse, yes. But this really started with Trump's trade war in 2018. That, like I said, there's a thread that runs through all these things. So not to throw out my hands, I'm not going to do that. But when you ask me that, I'm thinking, well, I'm talking about China, Ukraine, supply chain, Biden, they're all a big deal. In terms of tragedy, probably the war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. The number one question, of course, everyone's concerned about inflation, but there's a big backstory there. But I always say, when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your, ability to feed your family or keep a roof over your head. So people get inflation. One of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50, and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, buy a new jacket or whatever. So there's kind of demand destruction. At the same time, you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say we're in a recession. I mean, it's not coming. We're in it. And there's data. I never make statements like that, Brian, without supporting it. So the standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. And there's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. And, there's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So you got to reverse engineer the 27-year-olds from Bangladesh who don't get out much. They're the ones really writing these algorithms. Brilliant engineers, but you'd have to show them around Wall Street. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right. So you're expecting a major correction in stock markets on the back of a recession.
I'm not alone. That is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, oh, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time ×3 in the sense that it's real estate, stocks, and other asset classes. So, I do. That is my view, but it's shared by a number of other analysts.
And that would mean like S&P coming off another 20, 30%?
Yes. And again, you have to remind people, 1929, everyone's like, October, I think 18th or 19th, it was late October 1929, the stock market fell 22% in 2 days. It wasn't one day, it was like 12% one day, 11% the next day, so 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So, we're down, NASDAQ's down, bounced back a little bit in recent days, down close to 30%, down, the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Talk to me about inflation, because, I was looking at some of the inflation numbers and you have to go back to the 80s to see anything that's approaching double digit. I remember being just a kid hearing about double digit inflation. I could kind of remember the gas pumps, the lines at the gas. It's like a distant memory of me in the 70s. But how do you talk to younger people these days about what inflation is or it means? Because I don't think people really grasp what it actually means to your savings or to the economy in even a medium term.
That's exactly right, Brian. And if you're a little younger than I am, but I lived through it. I started my career in banking in 1976. And I remember my wife and I used to kid each other. She was in advertising, I was in banking. And the inflation was so bad, you'd get a raise every like 4 or 5 months. And you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed whatever, a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. But Brian, you're right when you say we're putting up inflation numbers today that are the highest in 40 years. That is correct. A little 41, actually, it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning. It's like, oh, that's some inflation. Yeah, we did. But it had started. In some ways, it started in 1968, and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 80, 70, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power. Not 15, 50 in that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, in 1981, it was, 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Or is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. And again, there is this comparison to the 70s. By the way, I think the situation we're in today is very different from the 1970s, and I'll explain why. In the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war. And then the price tripled, but it went from like $2 to $6. Okay. But, percentage terms, that's a huge jump, but it was still $6. And then it got to 12. And then in 1979, you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because there's two different embargoes. So that's coming from the supply side. But what happened was the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where, supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or, kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described. And as I said, I lived through the 70s, where, hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food, you got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially. And the two things you can't do without are